All right, let's talk about a word that makes most people a little nervous: debt. But what if I told you that for some of the world's most successful companies, it's not a sign of failure at all? What if it's actually one of their most powerful tools for growth? Let's dive in.
So, just take a second. When I say the words successful company, what's the first image that pops into your head?
Are you picturing sales charts that just shoot off the page? Maybe it's a bunch of game-changing, innovative products that everybody wants. Or maybe it's just a giant overflowing bank account, right? Piles of cash with zero liabilities. These are the things we're all taught to see as signs of success.
But what if a key ingredient in their secret sauce was something we almost always see as a negative? What if their most powerful weapon was actually debt?
And this gets us right to the heart of the matter, the great debt misconception. We've all kind of been conditioned to think that debt is bad, full stop, that it's a red flag that a company is in serious trouble.
This quote from Bill Foley just hits the nail on the head. There's this pervasive myth out there that only badly run companies take on debt. But as we're about to find out, the reality is way more interesting than that. And that leads us to a really crucial distinction. Because it turns out not all debt is created equal. To really get this, you have to separate good debt from bad debt. And that brings us to the key concept here: leverage. Think about a real lever, the tool. You use a little bit of your own force to move something huge. Well, financial leverage is the exact same idea. You're using borrowed money to amplify your own capital so you can make much bigger moves. That's the whole game. This slide just lays it out perfectly. On one side, you've got strategic leverage. That's borrowing with a crystal clear plan to invest in growth, knowing how that investment is going to pay for itself, and then some. On the other side, you've got bad debt. That's borrowing just to stay afloat with no real plan, and it traps you on this vicious hamster wheel of repayment. Okay, so this isn't just theory, right? Let's look at how the real giants do it. Some of the biggest names you know have absolutely mastered this art. Let's check out a few examples. First up, Uber. They raised a massive $2 billion loan. Now, why would they do that? Well, this is a classic move. See, borrowing that cash was way cheaper than getting it from new investors. Every time you bring in a new investor, everyone else's slice of the pie gets smaller. That's called dilution. By using debt, they protected their ownership. And guess what? Shortly after, they hit cash flow positive for the very first time. Smart. Or how about this one? The Airbnb origin story is just wild. The founders literally had binders full of credit cards. Can you imagine? They racked up tens of thousands in personal debt just to survive those early days. This was debt as a pure lifeline when nobody else would give them a dime. Without it, the whole thing would have fizzled out before it even got started. Okay, but this one might be the most mind-bending of all. Amazon. When they bought Whole Foods, they had more than enough cash sitting around to just pay for it outright. But they didn't. They borrowed $16 billion anyway. So why on earth would a company swimming in cash do that? It was a genius move in what's called capital preservation. Interest rates were so incredibly low that it was actually smarter to borrow the money and keep their own cash free for other opportunities. A purely strategic financial play. So we've seen that smart companies use debt, but how can we, from the outside looking in, actually measure it? How do analysts tell the difference between a strategic move and a reckless gamble? Well, there's a key metric for that. The main tool in the toolbox is the debt-to-equity ratio, or just DE ratio for short. It's a simple but super powerful way to see how much of a company's funding is coming from borrowed money versus how much is coming from its own resources, the shareholders' equity. And the calculation is really straightforward. You just find a company's total liabilities on its balance sheet, that's everything it owes, and you divide it by the total shareholder equity. That's it. The number you get tells you how many dollars of debt the company has for every single dollar of its own equity. To put a real number on this, let's look at a giant like Apple. As of early 2024, their DE ratio was 3.77. What does that actually mean? It means for every $1 of its own capital, Apple was using $3.77 of debt to finance its assets. But hold on, is 3.77 a lot? Well, here's the tricky part. It completely depends on the industry. For companies with really stable, predictable income, like utility companies or banks, a high DE ratio is totally normal. Their entire business model is built on it. So you can't just look at this number in a vacuum. Context is everything. And that brings us to a really crucial point.
Leverage is incredibly powerful, but it's also a double-edged sword. Its ability to amplify things, well, that doesn't just work when times are good. It works both ways.
So here's the bright side. Let's say a leveraged company's profit grows by, say, 10%. The returns for its shareholders can get magnified way beyond that, maybe to 20% or even more. That's the magic of leverage. You get a much bigger bang for your buck. But here's the other side of that blade. If that same company's profit falls by 10%, that same leverage will magnify the loss for shareholders, potentially turning it into a painful 20% loss. The risk is just as amplified as the reward. And if you want a really stark, real-world example of this risk, we just have to look at Lehman Brothers right before it collapsed in 2008. Their accounting leverage ratio was over 31-1. Think about that. They had more than $31 of debt for every $1 of equity. When the market turned against them, that extreme leverage magnified their losses into catastrophe.
So, what's the big takeaway here? It's that we need to reframe how we think about corporate debt. It's not necessarily a trap to be feared, but a powerful tool that has to be handled with skill and a really smart strategy. So let's just put it all together. Debt, by itself, isn't good or bad. It's just a neutral force. When it's used strategically, we call it leverage, and it's a tool that amplifies everything, for better and for worse. In the end, its value really comes down to one simple question. Is there a smart strategy behind it? Which leaves us with one final question to think about. For any company that's trying to grow, the decision to use leverage is really a calculated bet on its own future. So is that a risk worth taking? Well, as we've seen, the answer lies in the strategy behind the debt.